As you guys are probably able to tell, I'm a big fan of clean energy stocks on this channel, as I've consistently talked about plays like Nikola, Plug Power, XPeng Motors, etc. But on top of these EV and hydrogen stocks, one of the sectors that's equally as important but often overlooked is the battery segment. You see, the demand for battery energy storage specifically is actually expected to grow faster than EVs this decade, and in this video I'll be going over the exact stock that I'm personally buying to take advantage of this rapid growth. I'll explain their unique business model and share precisely why this company could potentially be an easy double by 2023. I'm very certain that you guys are going to find this stock extremely attractive. But before we get into it guys, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So without further ado, let's get right into it. The stock in question is ticker symbol STEM or STEM, which is a software and battery company that essentially sells energy storage units for grid companies, commercial businesses, and even some residential customers. For those that might not be familiar with energy storage, this segment of the energy infrastructure is by far one of the most fastest growing and most stable segments because of the rapid adoption of renewable technologies. The key idea here is that since solar and wind are extremely intermittent and they're often very weather dependent, energy storage is often needed to allow customers to effectively use these solar and wind energies. I mean, think about it. If you have a solar panel installed on your roof and all of a sudden for 5 days you have an overcast weather, how exactly are you going to produce your energy? The only realistic solution is going to be to store excess solar energy when your house or your apartment does not need it. And you store that energy until the sun is not shining. And what sets STEM apart in this entire energy storage business is the fact that not only do they sell batteries at around a 30% gross margin, but they also sell an artificial intelligence software on top of that at around an 80% gross margin. And since obviously it's very difficult to gain a lasting competitive advantage in the very highly competitive areas of battery cells, packs, and modules, the fact that STEM has 24 patents behind their artificial intelligence platform that's called Athena is going to be a massive competitive advantage for this business. You see, when people say they want to invest in renewable technologies and help with climate change, they often think about investing in solar and wind companies. But the big problem with those businesses is that those companies have very low margins and there's a ridiculous amount of competition in that space. And since there's already very little to be made in terms of efficiency improvements and enhancements through R&D, those technologies have become a very stale investment opportunity. And where the real edge is investing in energy storage businesses that can take advantage of higher adoption in solar and wind. In the long term, renewables are going to have to be most definitely paired with some form of energy storage mechanism, and as we all know, in the short term, batteries are the best solution for anything under 8 hours of storage. But I'm sure that the question on everybody's mind right now is why has this stock performed so poorly if the opportunity and outlook ahead of this business is so nice? And there's a couple of simple answers to that. The first one is that growth stocks, generally speaking, have gotten destroyed over the past few months. And a stock like STEM, which is trading at a price to sales of around $13 and is not profitable yet, is going to be the ultimate culprit of this insane amount of selling. And on top of that, something Wall Street also saw as a little bit of a problem in the short term is that STEM recently acquired another business for around $700 million in around 75% in cash and 25% in stock. And as we all saw from PayPal last year, typically when a stock is acquiring another business for a lot of cash, the stock tends to perform very poorly in the short term because investors think that the company is trying to expand very aggressively and their cash balance is obviously going to come down. But as we all know, that is only a short-term hurdle, and in 1 to 2 years' time, Wall Street is going to completely forget about that short-term reduction in cash, and they're going to start focusing on the insane benefits this acquisition is providing to Athena and STEM. Also, Energy's gross margin in 2020 was around 60%, and they have a significant amount of cross-sell opportunity and recurring revenue. And this allows STEM to not only target the commercial and utility businesses, but now they have a whole package for solar and batteries. And so they can immediately start targeting the residential units and some of the smaller businesses like big box retailers with a package with not only batteries, but also a very efficient solar management software. But if we now move on from the acquisition and some of the business related aspects of STEM, the real insane opportunity in this company is the fact that they're growing revenues by around 270% in 2020 as compared to 2021. And this right here is really what's my main driver in my aggressive investing in the stock at its current price. As you can see, they've initiated 2022 revenue guidance of around $350 to $425 million. And as you can see, in 2021, their annual revenue was around $127, a year-over-year increase of around 251%. And so what this means is that STEM is accelerating its growth, because if you do the math, from 2021 to 2022, that is around a 270% increase. And this price to sales ratio that I showed you, which kind of looks expensive right now, is with that $127 million estimate. And so in 2022, for the worst case, this puts STEM at a forward price to sales ratio of only around $4.6. And I don't know about you, but that is an extremely cheap valuation for a company that's growing at almost 250%. For example, a company like AI, which I also own in my portfolio, is trading at a price to sales of around $9.7, and they grew year-over-year revenues by around 42%. And in the most extreme scenario, a stock like CrowdStrike is trading at a price to sales of $33, while they grew revenues by around 62%. And one of the energy industry's leaders, Plug Power, is trading at a price to sales of around 32, with its year-over-year revenue growth of around 80%. Now obviously these businesses I just showed you are much more established and they're much closer to profitability, but I hope that puts into perspective the severe undervaluedness of a stock like STEM in this kind of market. And since in the long run, STEM could potentially be valued as a software company because of their 80% gross margin on their AI service, this company could definitely be worth well over a $20 price of sales. And so the bottom line for me is that even though in the short term, Wall Street is very scared of STEM because of the fact that it's a very high growth stock, and the fact that right now they're barely profitable even on their gross margins, in the medium to longer term, this stock could perform extremely well as people realize their execution ability and the fact that the battery energy storage market is expected to grow at an insane rate over the next 5 years. If we now quickly have a look at STEM's chart, as you can see, the stock was trading at around $20 at the start of the year and hit a low of around $7.26 before now bouncing above that 50-day moving average to hit around $12. Now, I personally started investing in STEM all the way in the summer of 2021, right around this $25 to $30 level. So I am considerably down on my position, but I've been continuing to buy the dip on the stock because I just see no bad news that has come out for this business, and the only thing we're seeing is a valuation correction. And it's typically these moments when the stock price is diverging from the health of the business that you're going to get some of the best opportunities for investing in growth stocks. I do think in the short term we might have bottomed around that $7 level, but I would definitely not complain if we get any opportunities to add shares underneath that $10 level. And the key here is that if we break above this $13 region, we could definitely make a very nice run for around this $15 to $17 area. And even if STEM doubles all the way to $20 tomorrow, you're only going to be paying around an $8.6 price of sales. And that is certainly a very attractive price point for a company that's expected to grow in the triple digits over the next few years, and one that has a potentially significant competitive advantage with their AI software. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comments section below your guys' thoughts on STEM and some of the other battery stocks talked about in this video. But anyways guys, I hope you enjoyed this video and I'll catch you guys in the next one. Take care.